Hey guys, happy Sunday. The AMC GO Plan. I heard about it just like you guys did on the Q3 earnings call on November 6th, and I have a lot of questions just like you do. So, in the interest of facilitating some discussion, I put together my thoughts on a slide deck. Let's run through it real quick. Just a reminder, nobody pays me. I haven't talked to anybody at AMC. Everything you're going to see here in this presentation is directly from the AMC press release, except for the questions that I ask at the end of the presentation. And I think these are things that we should be thinking about and talking about. There's also a lot of misinformation about what CapEx is and how it affects the financials. And whatever you think about the GO Plan, let's at least make sure we have proper understanding of the financial statements. And I will talk about that on one or two slides in this video. With that being said, let's get right into the info. Over the last few days, as I've been trying to gather my thoughts about what exactly do I think about the GO Plan and why the timing, why did AMC tell us about that on Wednesday of last week, I try and often put myself in the position of the executives or the board, and what were they thinking? What are they worried about? And so we have this slide to kick us off called The Problem. CapEx investing at AMC has been cut by 2/3, and you can see the bar chart here. These are real bars from AMC's CapEx spending over the last 5 or 6 years, dropping from over $600 million down to under $200 million because the company has been allocating all of the cash that they have free to paying off the debt. That cut in your CapEx spending risks market share loss as you're not staying up with the competition who is profitable and investing in their business, making their theaters more appealing to the customers out there. The other thing is, if you're not investing in CapEx, then your assets, projectors, seats, things like that, they wear out. And you can only put off CapEx for so long, and then everything is broken. And then you have this huge bucket of money you need to spend all at one time. And when that happens, you're going to ruin your financials. And so most companies, especially if they have a competent financial team, will have a CapEx plan, and they will replace assets according to a plan, not only to maintain the assets, but to update to current technology, the latest and greatest. And that is a little bit of what AMC is talking about with the GO Plan. Let's dive in a little bit further. As you guys probably know, if you listened to the call or you read the press release, AMC's plan over the next 4 to 7 years is to allocate $1 to $1.5 billion towards capital investments. As it says here on the screen, the investments will be in laser projection, seating upgrades, PLF, premium large format, XLF, Dolby, and IMAX format auditoriums. Not so long ago, IMAX introduced a new projector technology, IMAX with laser, and currently 18%, or about 42 of AMC's 223 IMAX auditoriums have this new IMAX with laser projector. Under the GO Plan, up to 2/3 of AMC's IMAX auditoriums would be outfitted with this new technology. That would be 147 out of 223. In addition to the IMAX theaters, AMC has the regular auditoriums with the old style projectors. And as we know, recently they started updating some of those to a new laser projector, similar to what I have on the screen here. These are very expensive projectors, and we will talk about the benefits of them in just a second. And under the GO Plan, AMC tells us that they want to double or triple the installation quantity of these new laser projectors. That would mean up to 6,300 AMC auditoriums outfitted with the latest and greatest laser technology. What are the benefits of the laser technology besides a brighter, crisper picture for the customers watching the movie? For the company itself, 30,000 more hours projector lifetime. Your assets last longer, and the manufacturer offers a longer warranty on the laser projector as well. In addition, you have savings of up to 70% on the energy bill required to power the projector versus a traditional bulb projector. Data also shows that the laser projectors have less maintenance, and therefore you have less maintenance cost and less downtime in your auditorium. In some locations, AMC has a premium large format brand called AMC Prime available in some theaters, and they're telling us that they want to increase the Prime locations from 31 up to 100 under the GO Plan. Dolby Cinema locations are also slated to increase under the GO Plan. That is the main auditorium I go to here in Austin, is the AMC Dolby Theater, because the IMAX is all the way on the other side of town. And these Dolby auditoriums are fantastic, but they tell us that they want to increase the number of them by 25%, bringing the global total to around 214. The final thing that AMC mentioned is rolling out this brand XL at AMC, similar to what they have been experimenting with in Europe, and branding the outside of the largest auditorium in the building, similar to what you see here, the branding as you go into an IMAX auditorium at an AMC. They're going to brand their largest screen, as long as it's 40 feet wide or wider, as XL. And they are still apparently deciding if they're going to charge more for that or just use it as a way to draw in potential customers. All of these expenditures, whether it's $1 billion or $1.5 billion, would be CapEx, long-term investment in assets of the company. So let's just talk 1 minute. What is CapEx? If you're an accountant or a finance major, or you've owned your own business, you already know the answer to this. But for those of you who are not familiar with that sort of thing, let's just talk about it for 1 minute. When we read through the financial reports from a company, we often see that they break down CapEx into two buckets: growth CapEx, investing in assets for the long-term growth of the business, and maintenance CapEx, CapEx which is generally used to maintain the business. So here with the GO Plan, I think we're mostly talking about growth CapEx. CapEx, or capital expenditures, are funds a company uses to purchase, improve, or maintain long-term assets that are used to generate revenue over time. CapEx is a key financial term that can help a company grow, become more efficient, and increase profitability. Whether you're in management at a company or you're an investor analyzing the company's expenditures on CapEx, what you should be asking yourself is the proposed CapEx plan going to increase profitability? Is it going to increase market share? If it does, if you think that it does, then perhaps that is a good use of money. And we'll talk about where that money comes from in just a minute. I have seen people putting out some misinformation telling folks that management is wanting to spend this money to hurt you, to suppress profits on purpose, to help the shorts, in other words. And guys, let's be real. There are no executives sitting around in a boardroom or a meeting room thinking, how do we limit profits? Everybody in that boardroom is pulling in the same direction, trying to figure out how to increase EBITDA, how to increase earnings. It is, in my mind, completely ridiculous to think that management is purposely trying to harm earnings, and maybe even harmful for some of you guys to be listening to folks on social media telling you that that is their intention. It just makes no sense. There might be some other things related to the GO Plan that you do want to worry about, and we'll talk about that at the end of this video. Moving on to the financial statements, though, where does CapEx show up? When money is spent on those assets, it does not even affect the income statement on the year that it's spent. It does affect the balance sheet, though. You spend cash, so your cash goes down on the balance sheet. You've bought an asset, so keep the balance sheet in balance, assets go up on the balance sheet. To track the use of that cash, over on the cash flow statement in the section called cash flow from investing activities, you will see a line item entry for CapEx. You guys are probably familiar with how operating expenses, day-to-day expenditures, show up on the income statement and reduce profits when the company reports its earnings per share. CapEx is not handled that way. CapEx is not operating expenses. As we just discussed, they will be logged the first year on the balance sheet only. But in accounting, all assets do eventually have to be depreciated, and that starts 1 year after the asset was put into use. Different assets have different useful lives, 5 years, 7 years, 10 years, and you divide the expense of that item over its useful life, and depreciation will happen every year on those assets. So eventually, yes, there will be some depreciation that shows up on the income statement, but the idea in accounting is you're expecting to generate additional income or profits from employing that asset. Through the use of depreciation, we time the expense of that item to the expected income and profits that the asset brings into the company's revenue stream. So one thing that a financial manager and even you as an investor should be asking is the asset that we're buying and eventually going to be depreciating going to bring in incremental income higher than the cost of that item? If it's not, then maybe you shouldn't buy the item. And as you're analyzing the GO plan and what management is telling you about it, you should be asking yourself, do we expect that we will receive greater income or greater market share or greater capture of the box office by purchasing these assets? That is really the fundamental question, one of several that I have. As we reflect back on AMC's CapEx budget, we can see that they do tell us how they bucketize it. The blue part of the bar is the growth part of their CapEx expenditures. The red part is maintenance. And you can see that since 2020, when the company really got in financial trouble, they massively cut back on their growth CapEx. And it has been lagging. And it's to the point now where maintenance CapEx to just keep things running is exceeding the amount of money they're spending on new assets, having the latest and greatest, having things that won't break. Anyone who has run a business or knows anything about accounting knows that you must allocate a reasonable portion of your revenue to investing in the growth of the business, staying relevant, maintaining or increasing your market share. And this has been a problem at AMC that they've not been able to do that for the last 4 years due to lack of liquidity, lack of revenue, and their objective to instead use cash to attack debt on the balance sheet. But that is just not a sustainable plan. Whether or not we like the GO plan, this chart right here is not a sustainable plan for the future of AMC. If we compare the numbers that AMC reports for a CapEx to Cinemark, AMC being in the blue and Cinemark being in the red, and Cinemark talking about investing in the future of their business on their earnings call a week or so ago, you can see if things stay the way they are, Cinemark with half the screens and half the revenue of AMC will outpace AMC on the investment in their business for their customers starting next year. And I think that that probably had something to do with the timing of why AMC is announcing the GO plan right now. Let's get down now to the real meat of this discussion. Where is the money going to come from? And what Adam Aron said in the earnings call last week is some of the components of AMC's GO plan are already being implemented now, and others will be implemented over time, but only as and when our financial resources prudently allow. One AMC investor wrote an email to AMC Investor Relations and actually got an immediate response from John Merryweather. And so I put a couple of bullets here about what John said, and I'll put that email up on the screen if you haven't seen it going around social media. But Mr. Merryweather wanted to clarify a couple points. He says, this is not an incremental investment. The timing and expense of CapEx under the GO plan will be calibrated to available capital, liquidity levels, and leverage ratios. The capital priorities of the company remain, first of all, liquidity. Number 2, reducing financial leverage. Number 3, strengthening the balance sheet. And then only number 4, investing in the business. Debt reduction has and continues to be a main focus. I know for me, that is something that I want to hear, that reduction of debt remains a primary focus. But they went on to say a few more things that still trouble me just a little bit. If I were to interpret Mr. Merryweather's email and what Adam said, then we could come up with several different ways to map out how this CapEx spend might look. And that is the gray lines on these 2 examples here, a 4-year plan and a 7-year plan, a $1 billion plan and a $1.5 billion plan, increasing the CapEx in the 4-year plan on the growth side to 150 million and knocking it out in 4 years, or 113 million in the 7-year plan and knocking out $1.5 billion over 7 years. But the other things that were said on the earnings call, and I pay very close attention to what management says, what else was said kind of concerns me. And this is just speculative at this point, but I don't think we should ignore what they said. We should ask for more answers or come up with our own ideas of potential risks based on what they're telling us in the earnings call. Adam Aron said on the earnings call, the second bullet item here, as we see it today, substantially heightened CapEx levels will only occur with rising EBITDA. That's great. That's what I want to hear. But he went on to say, or a sense within our shareholder base that it is wise to increase the pace of equity raising, not just to maintain our cash reserves or manage our debt load, but also for the purpose of increasing CapEx specifically aimed at accelerating our growth. Now, for some people, that might be a red flag, increasing equity raising to pay for the CapEx. And that's not for me to decide for you. That is something for you guys to listen to what they're saying and decide if that is a risk that you want to take on or not. CapEx is probably going to be required, as we saw in the chart with the declining AMC CapEx and Cinemark increasing their CapEx and AMC being worried about losing their market share. But I think it is important to point out here that they are raising the flag up the flagpole that, hey, we might want to come to you and ask you, do you want to accelerate the pace of equity raising to fund this GO plan? Assuming that the capital expenditures are spent wisely on things that increase the market share and the profitability of AMC, it might make sense for some of you to say, yeah, willing to wait a few years and see a payout then with increased profitability. And for some of you, that might not be a palatable plan. That is for you guys to decide if they decide to ask us about accelerating or increasing the pace of equity raising. I don't know what all of this stuff is going to cost, and I don't know how fast they hope to implement it, but here is yet another maybe accelerated plan where if they were to get shareholder approval to raise money faster from us, then they could spend $275 a year to upgrade the theaters and the laser projectors faster and spend $1.5 billion on CapEx over 4 years. So while we are hearing statements of responsible cash management, we are also hearing statements kind of testing the waters. Would shareholders be willing to fund a faster CapEx plan? And so that's something we need to think about. That's something that we need to ask them about and get some answers. The answers to those questions and what the plan is could be materially important to your risk assessment, to your plan, whether or not you wish to speculate in AMC stock or not. You guys know that I advocate that you allocate the majority of your money into companies with a long history of profits and a long history of growing revenues. But much like some of you, I like to speculate in a few fun plays like AMC from time to time. Timing is important, and understanding these risks is important as well. Timing as in get a low entry and sell into run-ups. Timing as in paying attention to when the company is telling you that they might do an equity raise, if you even get the luxury of that heads up. And sometimes we don't. And so I spend a lot of time with AMC trying to anticipate before they do it, when is an equity raise coming? Because I don't want to stand in front of that, even though I know it is necessary for the company to avoid Chapter 11. It does not mean that I need to hold through it. If I can anticipate, based on what the company is telling me, that there is a impending equity raise, then I can take a temporary exit from the play, wait for the price to drop and settle, wait for the equity raise to get done, and then come in and buy the stock while the price is still cheap. That is my trading plan for my own personal risk tolerance. Many of you have different risk tolerances and you do your own thing. That's fine with me. I don't care how you trade. Hopefully you don't care how I trade. At the end of the day, we all want to hopefully preserve our capital and make money when the opportunity presents itself. And I encourage you to always take the opportunity to lock in gains when that opportunity presents itself. Let me know your questions and comments down below. Did you learn anything from this video? What questions did it generate? What concerns do you have? What is your plan? I love to hear from you guys. Thank you for watching all the way through. I'm Tony Denaro, and I will see ya on the next video.